You may know our next guest from The Big Short. He was one of the investors who shorted the housing bubble before it crashed more than 10 years ago. He is now eyeing a few names that he is shorting this time around. Let's bring in Steve Eisman of Neuberger Berman. Steve, welcome back to Fast Money. Great to have you with us.
Thank you. Good to be back.
Obviously, for The Big Short, that was sort of a macro call. Are there macro shorts in this market? Are there big bubbles? Are there inefficiencies that you see?
I don't see a systemic problem. The banking system is in the best shape of the 30 years I've been analyzing banks. Is there going to be a recession next year or the year after? I don't know. I think we are in a global industrial recession as we speak. That's not the same thing as a recession because industrial companies are about 10 to 15% of the economy. But I think when the industrial companies report, it'll be pretty universally weak, almost without exception.
A lot of people have made a lot about how rates have been close to zero or below zero for a very long time. Are there any sorts of bubbles that have formed around that dynamic or no?
Are there pockets of bubbles? QE to me is what I like to call monetary policy for rich people, meaning it raises asset prices. It has zero impact on the economy. It actually has some very negative aspects to it. In other words, if you're a saver, it's not helping you, it's hurting you. So I don't find QE as helpful to the actual economy. It just causes asset prices to go up. Now, is that a bubble? The market's not that expensive, so it's not that bubblicious, but it definitely has caused asset prices to go up.
Okay. Let's talk about some of your individual ideas. I think that all the times that I've spoken to you over the past couple of years, you've been short Deutsche Bank. Are you still short Deutsche Bank?
Still short Deutsche Bank.
Okay.
3 years. 3 years in running.
Yeah. What will cause you to take off that short? Because it has already hit record low after record low after record low.
The problem Deutsche Bank now suffers from is they're trying to shrink themselves to profitability. And one thing we have learned time and time and time again post-crisis is that's impossible. And so they're going to shrink, and they're going to become less profitable, and I think the stock goes even lower, and then we'll see.
Does it go under? This is all happening as...
Banks go out of business for funding issues. There's no funding issues at this time of Deutsche Bank. This is purely a profitability problem.
And is this an idiosyncratic short, or do you also see opportunities to short other, or have you been short other German banks? Commerzbank.
Not other German banks, other European banks. The problem, when you take a step back and say, can we boil it down to a paragraph or a sentence, what does a bank do for a living? What a bank does for a living is it sells you access to its balance sheet for a price. And so if you want to calculate what's the absolute return of a bank, it's return on assets, the whole balance sheet. Then you just multiply that by the leverage, and you get the ROE. So ROA times L equals ROE. Simple formula. The problem with European banks is that they have sold access to their balance sheets too cheaply for decades. And the ROA has even gone down post-crisis, and the leverage has come down for regulatory reasons. And that's the problem with European. Deutsche Bank is just really the extreme example of what plagues most European banks all over the continent.
So with the ECB trying to reflate there, do you think that...
Oh, that's hopeless.
It's hopeless.
Hopeless. QE in Europe, put it this way, zero rates or negative rates, what does that mean? I think it means it's created global overcapacity because every stock buyback has been done, every deal's been funded, every PE has been funded, every venture capital has been funded, every startup has been funded. And so what you have is global overcapacity and deflation. So why would anybody think that doing more of the same thing would cause inflation is utterly beyond me. I think what the ECB is doing is a perfect example of trying to do the same thing over and over again and expecting a different outcome. That's the best definition of insanity.
But that sounds systemically horrendous, ultimately. And the assumption is that the central banks can continue to print money, and therefore it doesn't really matter. Is that really, because again, that's the funding argument? Because we talk about $17 trillion in negative yielding assets all the time.
Right,
that sounds like a bubble.
They can keep funding because, take a look at Japan. Japan's government debt to GDP is 240%. We're at, I forget where we are now, 125, something like that. So we got 2 times more to go. And whose rates are lower? So, I I don't understand completely why Japan's rates are lower than ours. I just only know that they are, and they have a lot more debt to GDP than we do. So, what causes interest rates to go up in a world of QE is above my pay grade at this point.
Steve, what do you make of? We were just talking about zero interest rates, QE. It's obviously great for people who own risk assets. If you think about what's different this time to, let's say, 20 years ago, as far as technology valuations are concerned, is that we just saw some companies come to public markets, and they were able to be funded by this zero interest rate environment. And I'm thinking of Uber that had an $80 billion valuation. Now it's about 50. Okay, and then we had WeWork, that was originally at 47.
Bonds at 10%.
And might go to
maybe
zero,
15.
It might go to zero.
Yeah.
So my question is all these companies were funded by this environment. They're disintermediating massive companies that are public, that are profitable, all that sort of stuff. Is that a bubble? Are we about to see the reckoning of that on the backside? Because we're seeing some damage.
It's possible that bubble has broken to some degree, in that every single IPO, and I'm not picking on anybody, right. Smile Direct, for example, which is, I think it went public at 23. Where did it close today? 10, 11. So I think the public's appetite to take private equity out or venture capital out for companies, no matter how good their ultimate business models may be, but that don't make money, I think is, at least for the moment, is done. Now, what's that going to mean for Silicon Valley? Maybe it'll mean, God forbid, the companies will have to learn how to make money.
Some of your other shorts that you've spoken publicly about, Steve, Zillow.
Yes.
And Tesla.
Yes.
What is the short?
I'm still short both of them.
You're still short both of them?
Yes.
What is the short that you are the most excited about?
I'd say those would be two of them.
Zillow and Tesla.
I think Zillow has created for itself perhaps the most dangerous business model that I've seen in a very, very, very long time.
Because they started house flipping
Because they're
themselves.
flipping houses.
Yeah.
And, the CEO, I think his last name is Barton, is without question a great internet investor. But I think the example of Zillow is a case of genius is not always transferable. So, for example, some people might think I'm a very good investor, but my wife doesn't think I'm too bright when I come home. And, or you could be a great physicist, but you can't ride a bike. So you could be a great internet platform creator, and I grant you Barton is, but the business of buying homes, flipping them, requires making a good investment decision at a very, very low margin business, and it actually requires managing thousands upon thousands of human beings, because the internet is not going to paint the house for you. A person has to do that. The internet's not going to pull the carpet out of the house. A person has to do that. And this is a business. The problem with the business is that internet platform companies love to talk about the TAM. They wax poetic about the TAM.
Total addressable market.
And the total addressable market. And when they announced this, the CEO went on about the TAM for 10 minutes. I mean, it's like poetry. And the problem is there isn't one TAM for residential real estate. There are thousands of local TAMs, and they're all different. And the ability to make mistakes in every single one is very, very high. This is not a business you want to roll out quickly because it's so local. You want to learn from your mistakes. And this company is doing this so aggressively that it's bound to make a lot of mistakes.
Are either of these shorts, Tesla or Zillow, are these shorts that basically the bet is that they go out of business in some way? They go bankrupt?
No, that's not my bet. I'm
Okay.
not making that bet. I'm not making the bet that Tesla's going to go out of business. I'm not making the bet. I mean, it's rare to make, especially in a world of zero rates where everybody gets funded,
right,
to make a bet that somebody's going to go out of business. I mean, the problem is also when the stock gets to 2, chances are it goes to 6 before it goes to 0.
Do you think there's misrepresentation in either of these stories? In other words, the public is not getting a transparent or an accurate read in the true balance sheet story?
You know, with respect to Tesla, he likes to pull a shtick every quarter because there are 4 things that matter with Tesla. There's the deliveries, there's the margins, there's net income, and there's cash flow. And at least for the last 2 quarters, what he likes to do is tweet that they're doing very, very well on the deliveries, and the stock tends to go up. And then at least the last quarter, the other 3 variables are terrible, and the stock comes down. So I don't know why that's allowed.
Right.
But he's played this game again, where he's tweeting how great the deliveries are. We'll see how the rest of the earnings are when he reports.
Sure. Everybody asks you about what you're short because of Big Short fame, all that stuff.
Right.
What's your favorite long?
My favorite long is a company called Motorola Solutions, which it's a little obscure, but it's not a small cap stock. It makes emergency communication equipment for police, firemen, et cetera. You know, what I really like about it is it's very good management. They're well incentivized. It's an oligopoly, slightly regulated. Business has gotten better over the last couple of years. I don't have to worry about China. I don't have to worry that much about a recession. It's about as idiosyncratic a long as you could imagine.
Steve, great to see you. Thanks for coming by.
Thank you.
Steve Eisman, Neuberger Berman.
Or he could be like me and just have no discernible skills whatsoever. I mean, home, here, doesn't matter. I mean, at least
You're
he's
never
got
a
something
genius
going
anywhere.
for him. The Deutsche Bank is fascinating. We've been talking about it for a while. I mean, Steve, when I hear Steve talk, he's short it because it's just a bad bank, and that's good enough reason. My concern would be it's not only just a bad bank. You know, there's a derivatives book there which could potentially be, I hate using the word catastrophic, but there could be some systemic risk along the way. We're going to find out. But I'm with him 100% on Deutsche Bank. Even at current levels, it's still way too expensive.